Ladies and gentlemen, good day and welcome to Hi-Tech Pipes Limited Q2 FY'25 earnings conference call hosted by Capital India Private Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, you may press star then one on your touchtone phone to signal an operator. Please note that this conference is being recorded. I now hand the conference over to Mr. Vikas Singh from Capital India Private Limited. Thank you, and over to you, sir.
Thank you, Shifa. Good morning, everyone. I welcome you all on Q2 FY'25 Hi-Tech Pipes earnings conference call. From the management side, today we have with us Mr. Anish Bansal, Full-Time Director, Mr. Arvind Bansal, ED and Group CFO, and Mr. Arun Sharma, Company Secretary and Compliance Officer. Without taking any much time, I'll hand it over to Mr. Anish Bansal for his opening remarks. Over to you, sir.
Ladies and gentlemen, good morning, and thank you for joining us today for our Q2 and H1 FY'25 investor conference call. I'm joined on this call with Mr. Arvind Bansal, ED and Group CFO, Mr. Arun Sharma, Company Secretary and Compliance Officer. I'm pleased to report a solid performance this quarter, marked by significant achievements and strong financial growth, underscoring the resilience of Hi-Tech Pipes despite the industry's dynamic landscape. In Q2 FY'25, the company recorded a robust 22.5% increase in total sales volume to 1.23 lakh tons compared to 1 lakh ton in Q2 FY'24. This growth was driven primarily by rising demand for our steel tubes, structural steel products, and value-added solutions. Despite a 5.3% decline in revenue from operations due to lower steel prices, we have achieved remarkable profitability in this quarter. Our profit after tax increased by 72% to rupees 18 crores, and EBITDA rose by 57.6% to rupees 42.2 crores, with a notable 28% increase in EBITDA per ton, thanks to our focus on valued products and efficient cost management. For the first half of FY'25, revenue increased by 13% to rupees 1,572 crores, PAT surged by a remarkable 95% to rupees 36 crores, while EBITDA saw a 77% increase, reaching to rupees 85 crores. These results reflect our efforts in improving EBITDA per ton and operational efficiency. We also made strides in key financial metrics, reducing net working capital days from 63 to 60 days, and improving our debt-equity ratio from 0.7x to 0.49x, alongside a strong current ratio of 1.63x, and a notable improvement in ROC from 11% to 15%. A recent milestone was the successful closure of our QIP amounting to rupees 500 crores. This issuance was met with overwhelming interest from marquee qualified institutional buyers, showcasing strong confidence in Hi-Tech Pipes' growth prospects. The proceeds from the QIP provide us with the capital to execute our strategic initiatives under Hi-Tech 2.0. Now, please let me provide a broad outline of our vision of Hi-Tech 2.0. The launch of Hi-Tech 2.0 marks a transformational phase of Hi-Tech Pipes. This initiative encompasses several strategic actions that will drive our growth and solidify our position as a leader in the global steel pipes and tubes industry in the next 3 to 4 years. Number one, doubling manufacturing capacity. We are set to double our manufacturing capacity from 1 million tons to 2 million tons. This expansion aligns with our commitment to meet growing demand in sectors like infrastructure, building and construction, renewable energy, among others. Becoming the second largest manufacturer of ERW steel tubes and pipes. By increasing capacity, we are on track to become the second largest ERW steel tubes and pipes manufacturer, further strengthening our critical applications worldwide. Aiming for net debt-free status by FY'25 end, we are focused on strengthening our balance sheet with a goal of becoming net debt-free by FY'25, which will provide us with greater flexibility to reinvest in growth and enhance shareholder value. Fourth, strengthening brand presence in India and globally. We are expanding our market presence, aiming to establish Hi-Tech Pipes as a trusted brand worldwide through strategic marketing and customer engagement initiatives. Fifth, reducing incremental working capital. Our commitment to reducing incremental working capital will streamline operations, enhancing our operational efficiency and supporting growth. 6, focus on value-added products. We are placing a strong emphasis on value-added products, catering to specialized industries like renewable energy and infrastructure, which not only diversifies our portfolio but also captures higher margins. Lastly, exploring new markets, applications, and geographies. By exploring new product markets and new regions, we aim to drive sustainable growth and expand our footprint across the nation. I want to highlight the positive momentum created by the government's capital expenditure on infrastructure, which is expected to drive demand for steel products and especially steel pipes and tubes. Hi-Tech is well positioned to capitalize on this growing demand with an enhanced capacity and strong strategic roadmap in place. Thank you. We can now have questions and answers.
Thank you so much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have first question from the line of Muskan Rastogi from B&K Securities. Please go ahead.
Hello.
Hi, good morning, Muskan.
Hi, sir. Sir, I have a few questions. The inventory level has gone up in the first half as compared to FY'24. Is this because you stocked up some inventory on the account of lower steel prices?
So, Muskan, this inventory increase in line with our new expanded capacities. We have installed our new facility in Gujarat, in Sanand, Unit 2. So, with the incremental volumes, incremental sales volumes, so the inventory is also rising. But, the incremental volume rise is lesser than the overall volumes.
Okay, sir. So, I wanted to know how much of the sales mix is coming from dealers and OEMs, and also can you please tell us how many manufacturing lines do we have currently?
So currently, 62 to 63% is coming from our trade and distribution network, and balance 37-38% is coming from OEMs, projects, and some big corporates like Reliance and Adani.
And how many manufacturing lines do we currently have?
So currently we have 6 manufacturing locations and 1 new greenfield unit is in pipeline. So by the end of this financial year, we'll have 7 manufacturing facilities across India.
All right. Okay, sir. And so within hollow sections, we are planning to add higher dia pipes. So does these high dia pipes like 500, have better margins than 200 by 200 millimeters?
Yes, Muskan. So, big sizes will definitely fetch a higher EBITDA per ton. And currently, we are doing up to 250 by 250. But then there are, strong plans of increasing this up to 500 by 500 very shortly.
Okay, how much better, sir, the margins would be?
So, in higher, sizes, which go like beyond 300 by 300. So, there is a, EBITDA per ton in the range of 6,000 to 7,000 rupees per ton.
Okay, sir. And so one last question. The presentation that you have mentioned has 500 plus dealers and distributors. So further, roughly how many fabricators are we connected within India?
So with 500 dealers and distributors, there are approximately 20,000 fabricators that are attached with these dealers. And going forward, as we increase our production and as we increase our geographies, so, this number will go up quite significantly.
Okay, sir. Thank you so much, sir.
Welcome.
Thank you. The next question is from the line of Sneha Talreja from Nuvama. Please go ahead.
Hi, good morning, sir, and thanks a lot for the opportunity. Just a couple of questions from my end related to EBITDA per ton. Now, your PPT states that you've done EBITDA per ton of 3,429, And in the interview, if I'm not wrong, we heard it out that you have mentioned that there was an inventory loss of what, 600 to 700 per ton. So just wanted to understand that despite inventory losses, have you actually seen improvement in your EBITDA per ton? If that's the case, what are the reasons for same?
Yeah. Good morning, Sneha. So, firstly, as you recall, in Q2, the company, procured big orders from the renewable energy side. And we predicted this steel price volatility, because of the China, stress. And in the month of July, so we gathered a lot of fixed price orders that helped us in mitigating, this 600-700 rupees inventory loss. And additionally, we did not resort to additional discounts to our dealers and distributors. So that was main reason, that our, EBITDA per ton did not go down significantly. Additionally, there were like a lot of imports being done by the industry, but then we resisted from the imports, and we, had a very limited, steel price reduction risk.
So ideally speaking, if I understand, in fact, imports came in at a slightly cheaper prices. So without resorting for that, your EBITDA per ton came higher. And also one of the reasons that you mentioned in your interview is that, you got some rebates from from the producers out there of HRC. Just failing to understand that, why is it so differentiated when the leader actually reports a, much higher significant EBITDA loss and, we get those rebates and so somewhere unable to, align it.
So, yeah. So firstly, imports. So at the time of ordering the imports, the prices were cheaper, but then when the imports actually landed in the country, they were higher by 2,000 to 3,000 rupees per ton. So there was a big, inventory hit, import hit, in that, when the imports landed in the country. So this was one big impact. So when we were ordering the imports, they were lucrative, but then finally when the material landed at the ports, it was quite expensive. Secondly, yes, there has been support from the steel mills. They have seen the market conditions, and they have given support to many players.
Understood. Lastly, if I may ask, what is the percentage of your revenues that you're getting from the solar projects activity?
So currently it is 10%, and I think going forward, we'll take this up surely with our new capacities.
Understood. One last one, if at all I can squeeze in, what would be a regional mix? Can you share the numbers of North, West, South?
So, Sneha, can you repeat that?
Can you please share your regional revenue mix with us?
Oh, so it is, around 40% is coming from the north.
Okay.
And 35% from the west and central India.
Okay.
And 25% is coming from the southern north.
Understood. Thanks a lot, sir, and all the very best. If more questions, I'll come back at you.
Thank you, Sneha.
Thank you very much. Participants, just a reminder that if you wish to ask a question, you shall press star and 1 on your touchtone phone. We have next question from the line of Pallav Agarwal from Antique Stock Broking. Please go ahead.
Yes, sir. Good morning. So this question on our volume guidance, because our first half volumes have been very good. So what sort of volume and EBITDA guidance do we have for FY'25?
Yeah. Good morning, Pallav. So basically, in the first half, we have done approximately 2.5 lakh tons of sale volume, 2.45 to be precise. And, we are sticking to our guidance of 500,000 tons, 0.5 million tons for this financial year. And with the new capacities that are coming at the end of this quarter or end of this financial year, so we'll have, a jump in FY'26. So with the current capacity in hand of 0.75 million tons, we'll be doing 500,000 tons of sales volume for this financial year comfortably.
Okay. And what about, the EBITDA per ton has been gradually, improving. So, with the higher value-added proportion being targeted, So, I think first half our average EBITDA per ton is probably around 3,000, close to 3,500 rupees per ton. So
Yeah.
what sort of trajectory can we look at, going ahead?
That our focus is towards value-added products, and we have developed various new products in the in the renewable energy side, in railways, in telecom sector, and that process is going on continuously. And our internal target is to take this VAP share from 36-37% currently to 50% in next 1.5 to 2 years. And the new capacities that are coming up are focused towards value-added products. And I think this EBITDA per ton will be growing significantly. There'll be a gradual improvement every year, and in next 1.5 to 2 years, it will be reaching a good. There'll be a good growth in that direction.
Sure. Just on this acquisition, if you could just explain this acquisition in terms of what was actual cash consideration, paid for this, and what is broadly the rationale of the acquisition?
Sorry, can you repeat that?
Yes, I just wanted to, on this acquisition of, I think, high-tech, mentioned in the press release. So I just want to understand, so what was the actual cash consideration? So it is just the paid-up share capital, or, there was some premium, paid for acquiring this high-tech Global Steels Private Limited?
Yeah. So this company, we have acquired this company, it's a 100% subsidiary, and, the new projects, new plants, it is for the new plants that will be taken care.
Yes, sir. So what was the cash consideration?
There's no premium. It's on paid-up capital only.
So this is 1 lakh rupees, is it?
Yeah.
Okay. Yeah, thank you.
Thank you very much. We have next question from the line of Radha from B&K Securities. You may proceed, please.
Yes, hi. Thank you so much. So in this quarter, if I see the purchase of stock and trade number, last quarter that was 99 crores, and this quarter it is 7 crores.
Okay.
So please help me understand what is this purchase of stock and trade? Is this the trading in HR coil that we are doing every quarter?
So, these are the, tubes and pipes that we had sourced from the market when the capacity was, less. But now with our new capacities in hand, we not need to do that. So I think that is over with.
So your annual report mentions that it is completely HR coil. So that's why I was wondering.
So this is, some rejections or some odd sizes that come in. So it is pertaining to that only.
Okay. So if I remove this purchase of stock and trade and see the gross profit X of this purchase of stock and trade, which you said that this quarter you have not done. So the gross profit per ton, so your realizations are down 20% on a QOQ basis, and your raw material cost X of stock and trade purchase is down 10%. So ideally, what I understand is the inventory loss could have been much higher for this quarter, but I'm unable to understand the numbers. So please help me with this.
So basically, the inventory loss that came in, of course, like the steel prices got down, so we had inventory loss. But then the overall blended, because this scenario was very evident in the month of July, because when the international steel prices were going down. So in that situation, we purposely and strategically we took a lot of fixed price orders, especially from the renewable energy side. You must have seen our our announcement earlier. The company secured its the biggest ever order from the solar side, and that helped us in sailing through this period. And we knew whatever prices, fixed price orders we'll have in the month of July, so it will help us in sailing through this period.
Yes, sir. Considering all the solar, so on a blended basis only, so that includes the solar type number. So blended basis realizations, I can see that it has fallen by 13 rupees per kg on a QOQ basis. And like you mentioned that this quarter there was no stock in trade. So if we remove the stock in trade, so I can see the gross profit per metric ton has fallen by 7 rupees per kg. So that should include a higher inventory loss?
Actually, we need to calculate this gross profit considering this raw material cost, change in inventory and stock and purchase of stock in trade. If we consider all this and if we compare on quarter-to-quarter basis or year-on-year basis, our actual inventory loss is in the range of 600 to 700 rupees only. And that has been mitigated by various factors, which has been mentioned by Anish Bansal. I think you are not considering this change in inventory in your calculation. It might be so.
Yes, yes, sir. No, I am just excluding this purchase of stock in trade, which as per annual report was mentioned that it is HR coil trading that is being done. So if we remove this, so on the basis of the products wherein we are doing the value addition, X of the traded material, so there I can see a higher drop in gross profit per ton. So just wanted to understand these numbers, sir.
Actually, this trading, as Anish Bansal has mentioned, this is only a temporary phenomena on account of the non-availability of capacity at that time. Now we have already added the capacity. Now capacity is available. Now we are not focusing on the trading volume. We are just focusing on the manufacturing volume to increase our capacity utilization. To explain you the number, we can connect with you separately also.
All right, sir. So secondly, from the industry perspective, so today the market size in India is 9 to 10 million tons. And Hi-Tech is having a product portfolio of all 4 products, that is MS pipes, hollow sections, GI as well as GP pipes to cater to this market. So please help me understand how is the market divided in terms of these products, like roughly what percentage of total market would be MS versus hollow versus GI and GP?
Out of this total capacity of 8 to 9 million ton, around 50 to 60% market is for the hollow sections. And around 20% market is for the GP pipes. Around 20% market is for the galvanized pipes. And the rest is for, say, your cold door pipes, HR pipes and all this.
All right, sir. So, you mentioned to the previous participant, you gave your sales mix region-wise. So, from the industry perspective, if you can give that, how is the industry divided between North, East, West, and South India? And going forward, where are the supply gaps that you can see, and where do you want to focus more?
Yeah, currently, our sense is, 80% of the demand is coming from the north, west, and the southern market, and 20% is coming from the eastern side. And going forward, we see a strong potential in the north, west, and south states. So we'll be growing, organically in this through our brownfield route.
All right, sir. The third question is that, again, to a previous participant, you mentioned that in terms of pipe dia, if we increase the pipe dia beyond 300 into 300 mm, so there is an EBITDA per ton of 6,000 to 7,000. So wanted to know the same number for below 300 into 300.
So, that is ranging, from like product to product, size to size. So, you can take it, ballpark between 3 to 5,000 rupees per ton, depending on, a specific size.
Okay, that gives a huge delta between if we increase the pipe dia. So, when do we plan to launch this 300 into 300 or 500 into 500 mm?
So we are working there. So, a year and a half, we should be there.
All right. last question to a previous participant, if I heard correctly, you mentioned something about the telecom sector demand. So please could you elaborate this point?
As you know, there's a lot of 5G deployment that is going on in the country. And, after Vodafone Idea, they, becoming active now. So, their capex was missing from last 2 to 3 years. But now they are also in capex mode, and a lot of new tower deployment is going to happen in next 1.5 years. So our focus is there, and I think, this sector will be, a big demand driver for the sector.
Thank you so much. I suppose the line from Ms. Radha has been disconnected. We will proceed with the next question from the line of Amit Vora from Ginar Consultants. Please go ahead.
Good afternoon, gentlemen. Thanks for the opportunity. Just wanted to understand how are we spreading our brand spends over the next 2 years? What are we doing and working on this?
Yeah, good morning. Good morning, Amit. So yes, we are strongly focusing on brand creation for high-tech pipes, and a lot of work is in progress in the same direction. And very shortly, I think we'll have good news for the markets for our tubes and pipes segment. The company will come out with a big branding and marketing initiative.
Any ballpark number on what is the amount that you're going to spend over the next couple of years on that?
So it is still work in progress. I think, in a couple of months, we'll have a clear indication of what our total, advertisement and branding spend will be.
All right. One last question. Do we change any of our guidance? Sorry, I have missed that in case you have mentioned this. After the Q2 numbers and the first half numbers, are we revising our guidance?
So currently, we are maintaining our guidance. I think, we should we should reach there comfortably without because if we have done we have seen through H1 despite of the challenges from the election, monsoon, and the China stress, but H2 looks certainly promising.
Thank you, and all the very best.
Thank you, Amit. Thank you.
Thank you very much. Participants, if you wish to ask a question, please press star and 1 now. Ladies and gentlemen, if you wish to ask a question, you may press star and 1. We have a question from the line of Vikas Singh from Phillip Capital. Please go ahead.
Hi, sir. I have a few questions regarding the overall market size. Basically, if you look at along with you and the top 4-5 players are adding closer to 5 million tons of the capacity in the next 3 years. So how we should look at the demand side and which are the pockets you expected to outperform in the segments?
So, sir, currently, the market size is 10 million tons, and we see this market growing by 15% per annum. And with the new applications like solar and in the building and construction, there are new kind of tubes and pipes requirement that has come. So all in all, I think this segment, this market will be growing by at least 15% over a year.
So that should take care of the additional capacity.
Absolutely. So, we are adding capacity from a perspective of, 6 to 7 year vision. And once it is done, we are, thoroughly confident of, utilizing the same.
Understood, sir. So, India is basically adding a huge HRC capacities, and considering that pipe segment as a whole of the steel demand being 10%, they are the kind of a low-hanging fruit. So have we expect or from the company side to already get some rebates or the MOU, or we are signing MOUs which are on a more favorable terms in terms of working capital? If you could give us some insight into it.
Yes, sir. HRC is definitely, the capacity of HRC is rising. And, like going forward, if the availability is higher, I think, if the availability of HRC is higher, then the consumption, can also be higher. And if consumption is higher, then definitely, we'll have room, for new applications, new substitutions. So we are fairly confident that, with new supplies, so new product innovation will be taking place, where, we can certainly have the edge.
In terms of procurement, you said that you're already getting some rebates. Can we expect with the supply increasing, the rebates to go up further, or we have already achieved our desired result?
So basically, Steel Authority of India being, the leader, in this space, right now. So, they are working, all these mills, they do not want to encourage imports, and, they have aligned their prices, with the global markets. So, imports, they want to discourage the imports, and, to discourage imports, they are, balancing their price level. So they take a call, depending on the market situation. Q2 was a bit abnormal. So they are proactive, and they are taking decision accordingly.
Understood. So just lastly, on the fixed price percentage of our total sales, so what it would be currently in terms of order book position size?
So approximately, out of our monthly sales volume, so all our, OEMs projects, so these are on fixed prices.
Okay, and that would be broadly
35,
20-25%?
35%.
35%. Yes, sir. That's all from my side. I'll join the queue if I have more questions.
Sure, sir.
Thank you very much. We have next question from the line of Ronald Sayoni. Before we proceed with the question, I would like to remind the participants that you may press star and one to ask a question. We are taking the question from the line of Ronald Sayoni from Sharekhan Limited. Please go ahead.
Yeah. Hello, sir, and thank you for the opportunity. Sir, I had a question with respect to your upcoming CapEx. So have you decided, the mix of brownfield and greenfield CapEx for the next 1 million ton?
Yeah. Good morning, Ronald. So yeah, that is work in progress. So Central India is one where we are missing right now, and the eastern part, where we are still not there. There's no manufacturing facility there. We'll be certainly covering these territories and also strengthening our current, northern, western, and southern markets.
Okay, so it will be more of a broad-based.
Yes, absolutely.
And about this fixed price contract, so you continue to undertake fixed price contracts because if it can also hurt margins going ahead if the trend reverses. So is it a regular phenomenon, or it was just one-off phenomenon during Q2 which had salted your margins?
Yes, and when it comes to fixed price contracts, so we factor in some degree of like steel price volatility. We factor that in before taking the orders. So for the Q3, we are I think we are more or less we have covered whatever steel price hike that may be there.
Okay. So post Q2, how has been the trend in terms of demand and also the spreads? Have they still at around 2 to 3 rupees per kg, or has there been movement in the spreads? Also about the HRC prices. So these three things, if you can highlight post Q2, how has been the situation?
So I think the steel prices should move in a tight band from here. So like in Q2 there were like a lot of imports. All the mills have taken that into cognizance, and they believe the imports should not come in India, and a lot of restricting the trade have resorted to that, and I think the prices should move in a tight band, steel prices.
And about the spreads, how are they currently?
Spreads in terms of?
Between primary and secondary?
So there is a gap of around 2,000 to 3,000 rupees per ton between primary and secondary currently.
It's still there. It's not increased, right?
Yeah, it is stable there. And I think, the secondary steel prices will definitely be, like 2 to 3 rupees cheaper. Otherwise, there is no incentive for anybody to buy. So, this is it. And I think, it should be like this going forward. But this is a sustainable, differential between primary and secondary.
Thank you very much, sir, and best of luck.
Thank you, Ron.
Thank you very much. Ladies and gentlemen, if you wish to ask a question, you may press star and one. Participants, to ask a question, you may press star and one. We have a question from the line of Muskan Rastogi from B&K Securities. Please go ahead.
Okay. So from the channel checks, we found that these 1-2 day small functions like managers' conferences, mostly secondary steel is used because of the cost difference. So let's say primary market is 100 and secondary is 100 with the same spread of rupees 5 to 7 per kg. How do you see the conversion happening from this 100 in secondary in the future, and how will it narrow down?
So, Muskan, earlier, there was a price gap of 12 to 14 rupees per kg. If we go back, like, 6 to 7 months previously. And that spread has come down to 2 to 3 rupees kg right now. I think, within this gap, definitely, primary players will definitely have an edge over the secondary players. And, this, we are seeing a strong momentum coming from this side, from the, distribution, trade and distribution side. And it is only accelerating the shift from secondary to primary.
How much conversion will happen? If you can give a number.
It is very hard to quantify in terms of like, but then, like overall, we are seeing a lot of shift that is happening from secondary to primary in a lot of markets.
Oh, okay. So, the rebate that we are getting that you mentioned, is it a policy that the supplier gives, or is it because of the sharp decline, like a one-off rebate that we got, the suppliers gave? So let's say, like, if there is a steep decline in the steel prices, like 2K or 3,000 per month, and like we're seeing that a lot of correction has been happening. So will we continue to get the rebates, or how is it?
So HRC, Steel Authority of India Limited, the prices are governed by them for the entire nation. And these like Steel Authority, they have taken the imports into cognizance, and they have corrected their prices in line with the international prices. So whatever imports that has happened, the people have not made any money imports while they were cheaper at the time of ordering. But then when the material actually hit the port, there was no gain there. So, the mills are working with the international prices, in mind. And they are taking the decisions, depending on the market dynamics.
Okay. Okay, sir. So in telecom sector that you mentioned as a previous participant, what pipes are we using there, and what is the opportunity size there, if you could give the estimate?
Yeah. So these are high tensile steel tubes, and different grades of steel are being used, and different sizes are there. And there has been a shift from angular steel telecom towers to tubular steel tube towers in last 5-6 years, and this is accelerating now, the shift. And we see a strong demand coming from 5G deployment.
What would be the opportunity size, sir?
So, in India, we are adding approximately 50,000 towers every year. So this means approximately, 500,000 tons of steel tubes and pipes.
Oh, all right, sir. Okay, sir. Thank you so much.
Thank you very much. We have a question. Sorry. Ladies and gentlemen, that was the last question for the day. I now hand the conference over to Mr. Vikas Singh for closing comments.
Sir, on behalf of Phillip Capital, I would like to thank High-Tech Management for giving us the opportunity to host the Concall. Now I hand over to Anish sir for his closing remarks.
Our focus on innovation and efficient operations and market diversification positions us as a forward-thinking leader. We remain adaptive to market trends, seizing opportunities to meet the evolving needs of our customers with advanced steel solutions. As we move forward, we are confident that our strategic initiatives will drive sustainable growth, value creation, and reinforce our leadership in the steel manufacturing industry. Thank you for your continued trust and support in High-Tech Pipes. We look forward to delivering consistent and sustainable growth for our stakeholders. Thank you.
On behalf of Phillip Capital India Private Limited, that concludes this conference call. Thank you for joining us. You may now disconnect your lines.